Hello and welcome back to Wealth Wisdom World, your ultimate financial guide. In this special series, we're going to take you on a comprehensive journey through the world of finance, exploring everything from the basics of money to the nuances of investing. Whether you're just getting started or you're looking to deepen your understanding, this series is designed to equip you with the knowledge you need to navigate your financial future. So buckle up and let's embark on this exciting journey of financial literacy together.
Let's start by answering a simple question. What is money? Money is any item or verifiable record that is generally accepted as payment for goods and services and repayment of debts. It serves three main functions. It's a medium of exchange, the unit of account, and a store of value. But money wasn't always the coins and paper bills we're familiar with today. Money has a history as rich and varied as humanity itself. In ancient times, there was barter. Barter was the direct exchange of goods and services. But as societies grew and transactions became more complex, the limitations of barter became apparent. The need for a medium of exchange led to the advent of money. But what form did this early money take? Let's dive into the fascinating history of money. Commodity money is an interesting first stop on our journey. This type of money has intrinsic value and is determined by the substance that composes it. It could be anything that's relatively scarce and durable. Cowrie shells, for instance, were used as a form of currency in different parts of the world for centuries. Precious metals eventually took center stage as the most popular form of commodity money. Gold and silver, in particular, became the standard because they're durable, divisible, and limited in supply. But using chunks of precious metals was cumbersome. How could you be sure of the purity and weight of the metal in each transaction? This question led to the minting of coins, standardized chunks of precious metals. The Lydian lion, minted by the Kingdom of Lydia in the 7th century BC, is often considered the first true coin. As societies became more complex, the need for a more practical form of money grew. This led to the creation of representative money. These were tokens or pieces of paper that represented a certain amount of a commodity, like gold or silver, kept safe in a bank. The value of these notes came from the promise that they could be exchanged for their equivalent in gold or silver. One of the most notable examples of representative money is the British pound. In the late 17th and early 18th centuries, Bank of England notes could be exchanged for gold. The promise on these notes stated, "I promise to pay the bearer on demand the sum of." The shift from carrying gold to carrying notes that represented gold was a major leap in the history of money. But what if the money wasn't backed by any physical commodity? This brings us to fiat money, which is what most modern money is today. Fiat money is government-issued currency that isn't backed by a physical commodity like gold or silver. Instead, the value of fiat money is derived from the relationship between supply and demand and the stability of the issuing government. The confidence people have in the currency and the government's ability to maintain a stable economy is key. The transition from representative to fiat money wasn't always smooth. The U.S., for instance, fully transitioned to fiat money in 1971 when President Nixon ended the gold standard. This move had profound effects on the global economy and marked the start of an era where governments had more control over their monetary policies. With fiat money, a new question arises. If there's no gold or silver backing the currency, what keeps it from becoming worthless? This brings us to the concept of inflation and deflation, key factors in the purchasing power of money. Inflation is when the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. Central banks attempt to limit inflation and avoid deflation to keep the economy running smoothly. Remember the Zimbabwean hyperinflation or the deflation during the Great Depression? Both situations caused extreme economic hardship, showing the importance of stability in the value of money. As we move towards the present, we enter the age of digital money. This began with simple electronic representations of money, like the balances in your bank account, which could be transferred using checks or credit cards. But technology has given rise to more sophisticated forms of digital money, including cryptocurrencies. Cryptocurrencies, like Bitcoin, are a type of digital or virtual money that uses cryptography for security. They are decentralized, operating on technology called blockchain, which is a distributed ledger enforced by a network of computers called nodes. As we look to the future, we see that the journey of money is far from over. The rise of cryptocurrencies, the possibility of central bank digital currencies, and the increasing shift towards a cashless society indicate that the nature of money will continue to evolve. Understanding the past and present of money is key to navigating its future. So, there you have it, a comprehensive dive into the basics of money. From its earliest forms as commodity money to the digital currencies of today, money continues to evolve alongside human civilization. Remember, financial literacy is power. It equips you to make informed decisions, secure your future, and contribute to a thriving economy.
Today, we're going to delve into the world of earning an income, discussing different ways people make money, what distinguishes these income types, and how you can potentially increase your earnings. So, are you ready to boost your income IQ? Let's get started. First off, let's talk about the basics. Earning and income are terms often used interchangeably, but they have slightly different meanings. Earnings usually refer to the amount of money gained from employment or business, often after tax and other deductions. Income, on the other hand, is broader and includes earnings from work and other sources such as investments, rental properties, or even a side hustle. Now, not all income is created equal. Generally, we can categorize income into three types: earned income, passive income, and portfolio income. Let's break down each of these. Earned income is what most people are familiar with. It's the salary or wages you receive from working a job or running a business. This is the active income that you have to put your time and effort into. Then, there's passive income. Imagine making money while you sleep. Sounds nice, right? That's the essence of passive income. It's the earnings you make from a source that doesn't require your active involvement. Think of rental income from properties, royalties from a book you wrote, or earnings from a blog you run. Lastly, we have portfolio income. This comes from investments in stocks, bonds, mutual funds, and other securities. The interest, dividends, and capital gains from these investments contribute to your portfolio income. Now that we've discussed the types of income, let's take a closer look at earned income. How do people decide what job to take or what business to start? How do they negotiate their salaries or price their services? How do they progress in their careers or grow their businesses? Choosing a career or business idea is often the first step. This choice can be influenced by many factors, including personal interests, market demand, skill sets, and educational background. Researching industry trends, consulting mentors, and understanding your strengths and weaknesses can help you make informed decisions. Once you've chosen a career path or business idea, the next step is often negotiation. Whether it's negotiating your salary at a job or setting prices for your business services, negotiation skills can significantly impact your earned income. Understanding your value, doing your research, and being prepared to walk away are some strategies to negotiate effectively. And finally, career progression or business growth is essential for increasing earned income over time. This can involve acquiring new skills, expanding your network, investing in business growth, or seeking promotions and raises. Now, let's move on to passive income. Generating passive income can provide financial security and flexibility, as it doesn't tie your earnings to the number of hours you work. Let's discuss some popular sources of passive income. Firstly, real estate. Rental properties can provide a steady stream of passive income. However, it's important to account for the costs of property management, maintenance, and vacancies. Researching the local real estate market and understanding property financing options can help you make informed decisions. Another source of passive income is royalties from intellectual property. This can be a book you've written, a song you've produced, or a patent you've developed. While this often requires significant upfront effort, it can lead to long-term passive income. Lastly, side hustles. These are small businesses or jobs you take on in addition to your main job. Examples could be blogging, selling handmade products online, or freelance consulting. While these may require some active involvement, they can often be managed flexibly and provide additional income. Finally, let's delve into portfolio income. Investing your money can be a powerful way to grow wealth over time. However, it's important to understand that all investments carry some level of risk. Investing in stocks allows you to become a part owner of a company. If the company performs well, you can earn money through dividends or by selling your shares at a higher price. However, if the company performs poorly, the value of your shares may decrease. Bonds, on the other hand, are a form of loan you give to a company or the government. In return, you receive interest payments and the return of the loan amount at the end of the bond term. While bonds are generally considered safer than stocks, they typically offer lower returns. Mutual funds are another popular investment option. They allow you to pool your money with other investors to invest in a diversified portfolio managed by professionals. This can be a great option if you're new to investing or don't have the time or knowledge to manage your own investments. Now that we understand the different types of income, let's discuss strategies to increase your earnings. Boosting your earned income can involve upskilling, networking, or seeking new job opportunities. For passive income, consider investing in rental properties, starting a side hustle, or creating intellectual property. And for portfolio income, consider diversifying your investments and regularly contributing to your investment accounts. Remember, there's no one-size-fits-all approach to earning an income. What works best for you will depend on your financial goals, risk tolerance, time availability, skills, and interests. And while earning more money can improve financial security, it's equally important to manage your expenses and save for the future. We hope this exploration of earning an income has provided valuable insights and sparked ideas for boosting your income. In the end, money is a tool, and the more knowledge you have, the better you can wield this tool to create the life you want. Ready to transform your piggy bank into a powerhouse of potential? If so, you're in the right place because today, we're talking all about savings. Why save, you might ask? Savings serve as a financial safety net, providing a cushion against unexpected expenses or opportunities. It's a step towards financial independence, allowing you to make life choices without constant worry about financial constraints. Going back in history, our ancestors' form of savings was pretty straightforward. They stored food and supplies to use in the future. However, as civilizations evolved and introduced money, savings became more abstract, representing a stored value for future use. Today, we broadly categorize savings into three types: short-term, medium-term, and long-term. Short-term savings typically cater to immediate or near-term goals like a vacation or a new laptop. These goals usually require you to save for less than a year. Medium-term savings, on the other hand, target bigger goals, like buying a car or making a down payment on a house. These objectives generally span from 1 to 5 years. Lastly, long-term savings focus on more substantial, future-oriented goals like retirement or your child's college education. These savings can take decades to accumulate. With the basics covered, let's delve into the how of saving money. Effective saving begins with setting smart, specific, measurable, achievable, relevant, time-bound goals. For example, instead of vaguely deciding to save for a house, structure your goal like this: I want to save $40,000 for a down payment on a house in 5 years. The next essential step is budgeting. Understanding your income and expenses allows you to plan how much to save each month. A popular budgeting method is the 50-30-20 rule, where 50% of your income covers necessities, 30% goes towards discretionary spending, and the remaining 20% goes into savings. Now, here's a pro tip. Whenever you receive any windfalls like tax refunds, bonuses, or gifts, resist the temptation to splurge. Adding these to your savings can significantly accelerate your progress towards your financial goals. But where should you stash your savings? Stowing all your savings under your mattress or in a current account isn't the best strategy. Instead, consider high-yield savings accounts, money market accounts, or certificates of deposit, CDs. Here's a quick breakdown. High-yield savings accounts offer higher interest rates than regular savings accounts. They're great for storing your emergency fund or short-term savings. Money market accounts combine the benefits of savings and checking accounts. They offer higher interest rates and come with check writing and debit card privileges. However, they usually require a higher minimum balance. Certificates of deposit, CDs, lock your money for a specific term ranging from a few months to several years. In return, they offer higher interest rates. CDs are excellent for medium-term savings where you won't need the money immediately. Another crucial factor in growing your savings is understanding the power of compound interest. Often referred to as the eighth wonder of the world, compound interest is a critical concept that can dramatically amplify your savings over time. But what exactly is compound interest? Simply put, compound interest is the interest you earn on both your original money and on the interest you keep accumulating. This means you're earning interest on interest, which can significantly increase the amount of money in your savings account or investment. Let's illustrate this with an example. Suppose you deposit $1,000 into a savings account that offers a 5% annual interest rate. At the end of the first year, you would have earned $50 in interest, bringing your total to $1,050. Now, for the second year, you're not just earning interest on your initial $1,000 deposit. You're earning interest on the entire $1,050. That means at the end of the second year, you'll earn $52.50 in interest, bringing your total to $1,102.50. As you can see, even though the interest rate remained the same, the amount of interest you earned increased. This happens because the interest is compounding, earning you money on the initial principal and the accumulated interest. What's even more exciting is that the longer you leave your money to compound, the faster it grows. This is because the effect of compound interest is exponential, not linear, meaning the growth curve becomes steeper the longer your money is invested or saved. This is why starting to save and invest early can have such a significant impact on your final savings balance. One of the great things about compound interest is that it requires no additional work on your part. Once you've deposited the money, compound interest takes over, growing your savings automatically. This passive growth is why Albert Einstein reputedly called compound interest the eighth wonder of the world. However, it's important to keep in mind that while compound interest is a powerful tool for growing your savings, it can also work against you. If you have debts with high interest rates, the interest can compound in the same way, causing your debt to grow exponentially. That's why it's so important to pay off high interest debts as quickly as possible. In summary, compound interest can be a powerful ally in achieving your financial goals. It turns your money into a money-making tool, enabling even modest, regular deposits to grow into substantial sums over time. By understanding and harnessing the power of compound interest, you can supercharge your savings and fast-track your journey to financial freedom. Lastly, remember that consistency is key when it comes to saving. Regularly saving smaller amounts often proves more effective than saving larger amounts sporadically. So, even if you can only save a small amount, the important thing is to start now and keep going. In conclusion, savings are the bedrock of personal finance. They provide a safety net, help you plan for the future, and are the first step towards achieving financial independence. That's it for today's video on savings. Each person's financial journey is unique, and what works for one person may not work for another. Stay informed, proactive, and find the savings strategy that works best for you. Today, we're diving into a topic that touches everyone's daily life: spending and expenses. We're not just talking about how to save money, we're talking about how to spend smarter. Are you ready to break free from reckless spending and take command of your cash? Well, buckle up, because we're about to embark on a journey to financial empowerment. Let's get started. Understanding the ins and outs of your spending and expenses is crucial for maintaining financial health. Every purchase you make, every bill you pay is part of your spending. It's a necessary part of life. After all, we need to spend money to eat, have a home, get around, and enjoy life. But it's also where many people can get into trouble, especially if spending is not kept in check. We categorize expenses into two main types: fixed and variable. Fixed expenses are those regular, consistent bills that you must pay, such as rent or mortgage, utilities, and insurance. They're typically the same amount every month, which can make them easier to plan for. Variable expenses, on the other hand, change from month to month. These include groceries, dining out, entertainment, and personal care. Since these costs can fluctuate, they require more active management to keep them in check. Managing your spending effectively often comes down to one essential skill: budgeting. Simply put, a budget is a financial plan that helps you allocate your income towards various needs, wants, and savings. It's like a roadmap that guides you in managing your money, ensuring that you live within your means and don't spend more than what you earn. Let's think of budgeting like this. You wouldn't embark on a road trip without a clear idea of your route, would you? Similarly, without a budget, it's easy to veer off course, overspending in some areas while neglecting others, like savings and investments. One highly respected and widely used budgeting technique is the 50-30-20 rule, formulated by Elizabeth Warren and Amelia Warren Tyagi. According to this principle, you should allocate 1. 50% of your income to necessities. These are your must-have expenses, such as housing, food, utilities, transportation, and healthcare. 1. They're the fundamental costs of living that you can't avoid. 2. 30% to wants. This category includes the nice-to-have expenses, things that you enjoy but could live without if necessary, like dining out, vacations, and entertainment. 2. It's essentially the portion of your budget that enhances your lifestyle. 3. The remaining 20% to savings and debt repayment. This includes contributions to retirement plans, emergency funds, and other savings, as well as any debt payments beyond the minimum required. The beauty of the 50-30-20 rule is its simplicity and adaptability. However, keep in mind that this is a general guideline. Everyone's financial situation is unique, so you might need to tweak these percentages to better suit your circumstances. Alongside budgeting, another cornerstone of effective spending management is tracking your expenses. In today's digital age, various mobile apps make this process easier than ever. These apps automatically categorize your expenses, allowing you to see at a glance how much you're spending on different areas. Tracking expenses can provide invaluable insights into your spending habits. You might discover, for instance, that you're spending a substantial amount on takeout coffee, or that your subscription services are adding up more than you thought. By identifying these areas, you can pinpoint where adjustments are needed and find opportunities to cut back. Moreover, tracking your expenses can foster a heightened sense of financial awareness, making you think twice before making impulsive purchases. It's a powerful tool in the quest for financial discipline. Overall, budgeting and expense tracking form a powerful duo in the realm of spending management. They provide clarity about where your money is going and equip you with the knowledge to make informed financial decisions. It's about taking control of your money, rather than letting your money control you. A key aspect of managing expenses is being aware of needs versus wants. Needs are things that are essential for living, like food and shelter, while wants are things that improve our quality of life but aren't strictly necessary. It's important to strike a balance between these two, covering your needs while still allowing for wants that make life enjoyable. That brings us to discretionary spending. This is money spent on non-essential things, like hobbies, entertainment, and vacations. While these aren't necessary for survival, they're important for our well-being. It's okay to spend money on these things, but it's crucial to do so within your budget. Also, consider the concept of conscious spending. This means being fully aware of where your money is going and making deliberate decisions about your spending. By focusing on what brings you joy and cutting back on unnecessary expenses, you can enhance your financial health without sacrificing your lifestyle. Lastly, remember that financial well-being isn't about never spending money. It's about understanding where your money is going, making informed decisions, and ensuring that you're saving and investing for the future. That wraps up our introduction to spending and expenses. Remember, financial wisdom is not just about making money, it's also about understanding how to use it wisely. So, keep tuning in to expand your financial knowledge. Ready to dispel the myths, break down the complexities, and truly grasp how to leverage debt to your advantage? Then let's dive in. Debt. The four-letter word that can evoke a range of emotions, from fear to stress, even shame. But let's demystify it. Essentially, debt is money borrowed, which you're obligated to pay back, typically with interest. This includes things like credit cards, student loans, auto loans, mortgages, and even personal loans from friends or family. In the realm of debt, understanding the difference between secured and unsecured debt is vital. Let's delve a little deeper into these two primary types of debt. Firstly, secured debt. This type of debt is secured by an asset, which acts as collateral for the loan. In practice, this means that if you fail to repay the debt as agreed, the lender has the right to take the collateral as a form of repayment. The most common examples of secured debt are mortgages and auto loans. In the case of a mortgage, the loan is secured by the house you're buying. If you stop making payments, the bank or financial institution that gave you the loan can seize the house, through a process known as foreclosure, and sell it to recover the money they've lent you. Similarly, an auto loan is secured by the vehicle you're purchasing. Again, if you can't keep up with the payments, the lender has the right to repossess the car and sell it to recoup their losses. The key characteristic of secured debt is that it tends to involve larger amounts of money for significant purchases, and thus, the interest rates are generally lower, since the lender has a form of security. On the flip side, we have unsecured debt. As the name suggests, this type of debt is not backed by any collateral. This means if you default on the loan, the lender can't automatically claim any specific property as repayment. However, they can take other collection actions, such as reporting the late payment to credit bureaus, hiring a collection agency, or filing a lawsuit against you. Examples of unsecured debt include credit cards, student loans, and personal loans. Given that these loans are not backed by an asset, they are deemed higher risk for the lender, which is why they usually come with higher interest rates compared to secured loans. Both types of debt can have a place in your financial strategy, but it's essential to understand their implications. Secured debt, if handled responsibly, can help you make significant purchases like a home or car and build your credit score. Unsecured debt, while typically more expensive, can provide quick access to funds when you need them. The key is to be aware of your borrowing, keep track of your ability to repay, and avoid taking on more debt than you can comfortably manage. Remember, debt is a tool, and like any tool, it's all about how you use it. Borrowing money isn't inherently bad. In fact, when used wisely, debt can be a tool to build wealth and improve your financial situation. However, problems arise when debt becomes unmanageable. So, how do we ensure that doesn't happen? The key lies in understanding the terms of your debt, having a clear plan for repayment, and making sure the debt you're taking on is good debt that contributes to your financial growth. When borrowing money, it's crucial to understand the terms of the loan. This includes the interest rate, repayment period, and any potential fees. Remember that lower monthly payments might seem attractive, but they often mean you're paying more in the long run due to longer repayment periods. Creating and adhering to a repayment plan is equally important. Prioritize paying off high-interest debt first, often credit card debt. This strategy, known as the avalanche method, can save you money over time. Remember, not all debt is created equal. Good debt can help you generate income and increase your net worth, like a mortgage. Bad debt, on the other hand, doesn't increase your wealth, has high interest rates, and is used to purchase depreciating assets, like credit card debt from buying clothes or gadgets. A particularly controversial form of debt is credit card debt. While credit cards can offer convenience and rewards, they come with high interest rates. If you're not careful, you can easily find yourself in a cycle of debt that's hard to escape from. Always aim to pay your balance in full each month to avoid paying interest. To conclude, borrowing can be a valuable tool in your financial arsenal if used responsibly. Remember, the goal isn't to avoid debt entirely, but to understand and manage it effectively. The key is to make debt work for you, not against you. That wraps up our session on debt and borrowing. You've ever wondered about the power of stocks, bonds, mutual funds, ETFs, real estate, and even cryptocurrencies to grow your wealth? Then this is the video for you. So buckle up, and let's take a deep dive into the strategies and mechanics of investing that could transform your financial future. Let's get started. Investing, at its core, is the act of allocating money or resources to an endeavor with the expectation of generating an income or profit. Whether it's buying stocks in a corporation, purchasing a rental property, or starting your own business, you're investing when you put your money to work for you. But why is investing so important? It's simple. Investing allows your money to grow. Unlike storing money in a traditional savings account, which offers minimal interest, investing provides the potential for substantial returns. This growth is crucial for goals like retirement, where you'll need a sizable nest egg to maintain your lifestyle. Understanding the different types of investments is key to building a diversified portfolio. Let's delve into some of the most common types. Let's take a closer look at stocks, one of the most popular and exciting forms of investment available to us today. When you purchase a company's stock, you're buying a small piece of ownership in that company. You become a shareholder, which means you have a stake in the company's success and potential profits. Each share represents a claim on part of the company's assets and earnings. There are two main types of stock, common and preferred. Owning common stock gives you the right to vote at shareholders' meetings and to receive dividends, which are a portion of the company's profits distributed to shareholders. Preferred stockholders, on the other hand, have a higher claim on dividends and assets, but they don't usually have voting rights. Investing in stocks has significant potential for high returns. For instance, If you had purchased Apple stock back in the early 2000s, your investment would be worth many times what you initially paid. This is because when a company performs well, its stock price can rise, and as a shareholder, you stand to benefit. However, stocks also come with higher risk compared to other investment types. This is because their value is subject to the company's performance and broader economic conditions. If a company underperforms or the economy enters a downturn, the company's stock price may drop. As a result, you could lose a portion, or even all, of your investment. For instance, during the financial crisis of 2008, many high-profile stocks saw significant losses as companies struggled with the economic downturn. Some companies even went bankrupt, leaving their stocks worthless. Despite the risks, investing in stocks can be a powerful way to grow your wealth over the long term. It's essential, however, to thoroughly research any company you're considering investing in. Understand its business model, analyze its financial health, and consider its potential for future growth. It's also a good idea to diversify your stock investments across different companies and sectors to reduce risk. Additionally, patience is key when investing in stocks. While the stock market can be volatile in the short term with prices rising and falling daily, historically, it has trended upwards over the long term. So, if you're investing for the long haul, short-term fluctuations should not deter you. Investing in stocks can be a rewarding venture, both financially and personally. Not only can you grow your wealth, but you can also become part owner of your favorite companies, sharing in their success. Let's dive a little deeper into bonds, which represent another key component of a well-rounded investment portfolio. In essence, a bond is a formal contract to repay borrowed money with interest at fixed intervals. When you buy a bond, you're essentially loaning money to the issuer. In return, the issuer promises to pay you a specified rate of interest during the life of the bond and to repay the face value of the bond, the principal, when it matures, or comes due. There are three primary types of bonds. Corporate bonds. These are issued by companies. Corporate bonds often offer higher interest rates, or yields, than government bonds because companies have a higher risk of defaulting. Municipal bonds. These are issued by states, cities, or counties and their agencies. The interest earned from these bonds is often exempt from federal income tax and may also be exempt from state and local taxes, making them particularly attractive to investors in high tax brackets. Government bonds. These are issued by the national government, and in the U.S., they come in two forms: treasury bonds and savings bonds. They are considered the safest bonds because they are backed by the full faith and credit of the U.S. government. Bonds are generally considered safer than stocks for a few reasons. First, bondholders have a higher claim on the issuer's assets than shareholders do. In other words, if the issuer goes bankrupt, bondholders are paid first. Second, bonds provide a fixed interest income, also known as the coupon rate. Regardless of how well or poorly the issuer does, as long as it doesn't default, it's obligated to pay you interest. This makes bonds particularly attractive to income-focused investors. However, the flip side of safety is that bonds have lower return potential than stocks. The issuer agrees to return the principal and a certain level of interest to you, but no more. Thus, when companies do exceptionally well, bondholders don't see any extra profit. Finally, it's important to note that while bonds are generally safer than stocks, they are not without risk. If the issuer defaults, you could lose your investment. Furthermore, bonds are subject to interest rate risk. When interest rates rise, bond prices fall because new bonds are issued at the higher interest rates, making existing bonds less attractive. Despite these risks, bonds serve a vital role in a diversified portfolio by providing steady income and a cushion against the volatility of the stock market. Let's delve deeper into mutual funds, a popular investment choice for many investors. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Each investor in the fund owns shares, which represent a portion of the holdings of the fund. There are various types of mutual funds, including equity funds. These are mutual funds that primarily invest in stocks. They can be further divided into a number of categories based on company size: small cap, mid cap, large cap, investment style, growth, value, blend, and geography: U.S., international, emerging markets. Fixed income funds. These are mutual funds that invest in bonds or other fixed income securities. They are often considered safer than equity funds and generate regular income for investors. Index funds. These are mutual funds that aim to replicate the performance of a specific index, such as the S&P 500. They offer broad market exposure and have lower fees than actively managed funds. Balanced funds. These mutual funds invest in a mix of equities and fixed income securities, balancing the aim for appreciation with the goal of income generation and capital preservation. One of the main advantages of investing in mutual funds is diversification. As they say, don't put all your eggs in one basket. With mutual funds, your money is spread across a wide array of securities, which can help minimize risk. If one company in which the fund has invested performs poorly, it's only a small part of your total investment. Additionally, mutual funds provide access to professional money managers who make investment decisions on behalf of the fund. This can be particularly valuable for investors who lack the time or expertise to manage their own portfolios. However, it's important to be aware that mutual funds come with fees, the most common of which is the expense ratio. This annual fee, expressed as a percentage of your investment, covers the costs of managing the fund. Some mutual funds also charge a sales commission, also known as a load. Furthermore, while diversification can help reduce risk, it doesn't guarantee a profit or protect against loss in a declining market. And while professional management can be a boon, it doesn't guarantee success. Despite these considerations, mutual funds can be a valuable part of an investment portfolio, offering diversification, professional management, and a range of investment options to suit different risk profiles and investment objectives. Exchange-traded funds, or ETFs, have become a popular investment vehicle in recent years. Similar to mutual funds, ETFs are investment funds that pool money from many investors. However, while mutual funds are only bought and sold at the end of each trading day at their net asset value, ETFs can be traded on an exchange throughout the trading day, just like individual stocks. This characteristic gives ETFs price flexibility, which can be an advantage to the investor. You can buy and sell ETFs anytime during trading hours at the current market price, giving you more control over the price you pay or receive compared to a mutual fund. Most ETFs are passively managed and aim to track the performance of a specific index. This could be a broad market index, like the S&P 500, or a specific sector index, like technology or healthcare. Due to this passive management, ETFs typically have lower expense ratios compared to actively managed mutual funds. There are also ETFs that track commodities, like gold or oil, bonds, or a basket of currencies. This gives investors a way to gain exposure to a wide variety of asset classes. Additionally, ETFs are known for their tax efficiency. Because of the in-kind creation and redemption process of ETF shares, which typically involves exchanging securities for ETF shares, rather than buying and selling securities, ETFs can often avoid triggering a taxable event. However, just like any other investment, ETFs come with risks. The ETF's price can fluctuate throughout the day, and there is no guarantee it will match the performance of the index it's designed to track. Furthermore, while ETFs generally have lower fees than mutual funds, you may incur brokerage commissions when buying and selling ETF shares. It's also worth noting that while ETFs offer diversification, this does not guarantee a profit or protect against a loss. As with any investment, it's important to consider your own risk tolerance, investment goals, and other factors before investing in ETFs. In summary, ETFs provide a versatile and accessible way for individuals to diversify their portfolios. They offer the flexibility of stocks, the broad diversification of mutual funds, and often come with lower costs. However, like all investments, they should be chosen carefully based on your individual circumstances and objectives. Delving deeper into real estate, we can see that it presents an entirely different kind of investment opportunity. Real estate investment involves purchasing physical land or property. This could include residential properties, like houses and apartments, commercial properties, like office buildings and shopping centers, or rental properties, either residential or commercial. This type of investment is often seen as a good way to diversify an investment portfolio beyond traditional securities. There are several ways to invest in real estate. Home ownership. The most common real estate investment is home ownership. While not often thought of as an investment, the potential for property value appreciation over time can result in substantial returns. Additionally, owning a home can provide a hedge against inflation. Rental properties. These can be residential or commercial. As the owner, you earn rental income from your tenants. Ideally, the rental income will exceed your expenses on the property, resulting in a profit. Also, like home ownership, rental properties can appreciate in value over time. Real estate investment groups, REIGs. These are a type of mutual fund for rental properties. If you want to own rental real estate without the hassle of being a landlord, a REIG is a good option. In a typical REIG, a company buys or builds a set of apartments or condos, then allows investors to purchase them through the company. Real estate investment trusts, REITs. These are companies that own, operate, or finance income-producing real estate. REITs offer a way to invest in real estate without having to own, operate, or finance properties yourself. Real estate crowdfunding. This is a newer way to invest in real estate, where you can invest in private real estate offerings through an online platform. Real estate investing offers several benefits. These include potential appreciation in property value, income from rentals, and tax benefits. In addition, real estate can be a good way to hedge against inflation, as property values and rental income tend to increase when prices rise. However, real estate also comes with risks. Properties may lose value, and income from rental properties may not exceed expenses. Real estate is also less liquid than stocks or bonds, making it harder to convert to cash. Whether you're considering residential, commercial, or rental properties, it's important to do your research, perhaps seek advice from real estate professionals, and consider your financial situation and tolerance for risk before investing. Cryptocurrencies represent a relatively new frontier in investing, and they are known for their extreme volatility but also for their potential for high returns. A cryptocurrency is a digital or virtual currency that uses cryptography for security. The most well-known cryptocurrency is Bitcoin, but there are now more than 5,000 different cryptocurrencies in circulation. Here's a bit more detail on a few prominent cryptocurrencies. Bitcoin, BTC. Launched in 2009, Bitcoin was the first cryptocurrency and remains the most well-known and valuable. It was created by an unknown person or group of people using the pseudonym Satoshi Nakamoto. Bitcoin introduced the concept of blockchain, a decentralized ledger of all transactions that is the core of most cryptocurrencies. Ethereum, ETH. Launched in 2015, Ethereum is more than just a digital currency. It's an open-source platform that enables developers to build and deploy decentralized applications, DApps. Its native currency, Ether, is used primarily for two purposes, as a digital currency like Bitcoin, and is used inside Ethereum to run applications and even to monetize work. Ripple, XRP. Ripple is both a digital payment protocol and a cryptocurrency. It was launched in 2012 and is now used by some major banks as part of their payment systems. Cryptocurrencies have several potential benefits. They provide a way to transfer funds directly between two parties without needing a trusted third party like a bank. They're also accessible to anyone with internet access, providing a way for people in unbanked or underbanked regions to access financial services. Investing in cryptocurrencies can potentially be very profitable. Due to their volatility, prices can increase rapidly, leading to high returns on investment. However, the same volatility can also lead to significant losses. Cryptocurrencies are also known for their high level of risk. They're highly volatile and can be prone to fraud and hacking. Also, because they're relatively new, they're not as well understood as more traditional forms of investment, and their legal and tax status can be complex. Furthermore, the value of a cryptocurrency is entirely speculative. Unlike a stock, which represents ownership in a company, or a bond, which represents a loan to a company, cryptocurrencies don't represent a claim on an underlying asset. In conclusion, while cryptocurrencies represent an exciting new frontier in finance with the potential for high returns, they also come with a high level of risk. As with any investment, potential investors should carefully consider their risk tolerance and do thorough research before diving in. Before you dive into investing, it's important to define your financial goals, risk tolerance, and time horizon. These factors will guide your investment decisions and help you create a diversified portfolio that aligns with your financial objectives. Another critical part of investing is understanding the power of compound interest, often hailed as the eighth wonder of the world. Compound interest means you earn interest not only on your initial investment but also on the interest that your investment has already earned. Over time, this can lead to exponential growth. Getting started with investing may seem daunting, but it doesn't have to be. There are plenty of resources available to help, from books and online courses to financial advisors and robo-advisors. Start with a small investment, continue to learn, and gradually build up your portfolio. Remember, investing is a marathon, not a sprint. It's about consistent, long-term growth, not quick wins. Stay patient, keep learning, and keep investing. Your future self will thank you. That wraps up our introduction to investing. If you found this information valuable, please like this video and share it with your friends and family. They might thank you one day when they're reaping the benefits of their investments. Stay tuned for our next episode, where we'll delve deeper into each type of investment. Until then, keep growing your wealth, wisdom, and world. Remember, you're not alone on this journey. We're with you every step of the way.